Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the massive growth companies right now in the consumer space is Celsius, the company that makes these little energy drinks right here that you may have seen more and more across the country, even at big box retailers. Celsius has expanded its distribution over the last year, and that has led to explosive growth for the company. I want to dig into their financial results and look at whether this is a stock to buy right now. I will say at the start, this is a very expensive company. So the question is going to be, are they going to be able to grow into their valuation? Well, let's dig into the numbers to get an answer to that. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing. I have a link to that in the show notes. Let's start with the quarterly report and some of the numbers that were reported. This is for the second quarter of 2023. Revenue was up 112%, just incredible growth numbers to $326 million. North American revenue was up 100 to $311 million. So this is primarily a North American beverage company. Keep that in mind because there is a lot of opportunity to grow overseas. Gross profit for the quarter was $159 million. So you're talking about a gross profit of nearly 50%. That's a tremendous gross profit level. And net income attributable to stockholders of $40.9 million or 52 cents per share. One of the challenges with growing companies is it often takes a lot of cash to generate this kind of growth. But Celsius has done a really good job containing its costs and growing more organically, so they don't have to spend quite as much on things like operating expenses, sales expenses. So they're able to generate this kind of growth and still generate a really good net margin of over 10%. Just very impressive numbers. You can see on the table here that they're starting to get a lot of operating leverage. That's why net income was up 345%, which is far exceeding revenue growth. And like I said, that international number just not very meaningful right now and not even growing as quickly as North American revenue. Now, I will say that the North American revenue is growing so significantly because of a distribution partnership with Pepsi. So some of this growth will be one-time in nature. When you get into, especially a lot of the big box retailers, you have a ton of growth filling the store shelves. So just basically putting inventory on the shelves. And when you get into a distributor like Pepsi, there's going to be a lot of front loading with that growth. So don't be surprised if the growth level slows down in coming quarters, potentially even goes negative, because you only have to stock those shelves for the first time once. Now, then you're going to see how much the throughput is on an ongoing basis. But I just want to flag that because we have seen this before with a lot of high growth consumer good companies, that you don't get that initial burst of growth from stocking shelves happen. That's not a recurring revenue source. Another point of strength for Celsius is their balance sheet. $681 million worth of cash on the balance sheet. Also has nearly $200 million of receivables. And then if we go down here to liabilities, not a lot of negative liabilities. You have $94 million in payables, promotional allowances, nothing really surprising, and no debt on the balance sheet. So just a phenomenal balance sheet for a very, very high growth company. The question for investors is, what do you pay for a company like this? You can see that the market cap is now $15 billion. The stock trades for 94 times next 12-month earnings, and enterprise value to sales is 16x on a trailing basis and 10x on a forward-looking basis. That means for the next 12 months, the stock trades for 10 times sales. Those are really, really high valuation numbers. Now, there aren't a lot of companies that are growing revenue at 100% per year, especially at a very high margin. So there is a reason that the company is getting this kind of valuation. That's kind of the sticking point, is maybe the stock is simply too expensive at this point. You can see that over the last 3 years, the stock has had a phenomenal run, going from about $20 per share up nearly 10x to $196 per share, even just in the last few months. In April, stock closed in the $86 range, more than double that at its current price. Now, it's hard to look at a company like this and not be reminded of the gains that Monster had over really the last 20 years. Just a stock that continued to run higher and higher year after year. I don't know if we have that again, but there are a lot of similarities. And the partnership the company has with Pepsi to distribute their products, I think, is a phenomenal relationship. It has obviously been very profitable, driven a ton of growth. My only problem with the stock right now is just simply valuation. Paying 10 times forward sales is just an astronomical valuation, because if anything goes wrong, if sales drops from 100% growth to 50% growth, the stock could fall 20, 30, 40, 50% in value. And that's just a risk that I'm not willing to take right now. This is a company that is absolutely on my watch list. It's a product I consume. I think they've done a phenomenal job with their brand, with their distribution, with their marketing. But especially in a market like this, where high interest rates are a headwind for a lot of companies, I don't want to be paying too much for a stock. And Celsius is just too expensive as a result. Maybe I'm wrong, but the risk to the downside with even a small earnings miss is just not a risk worth taking right now. But what do you think? Do you think differently? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.